this historic event is historic in one dimension, and that is the retail side of the fence played a major role in moving the market. I'd like to talk about three areas: the efficiency of the markets, risk management, and clearing and settlement. All three are involved in the GME debacle. I'm using GME as just a generic term for the whole situation. With respect to efficient markets, they always correct excessive behavior. And I think with the GME situation, we saw that the hedge funds were muscling retail holders of GME and AMC and the other stocks into submission. And they got a little greedy. And this usually precedes a major correction in the situation. And Reddit and Robinhood day traders saw an opportunity for the short squeeze. But let's be clear, the short squeeze was executed by the retail side, but it was created by the institutional side. The hedge funds created their own debacle. And that's a great segue into the concept of risk management. And in my mind, it's something I learned at Drexel Burnham. It's the most important aspect of money management. Picking stocks is a difficult game, but risk management is the most difficult and most important. And greed usually trumps risk management. And we're getting back to the concept of how does a hedge fund get into a situation where they have to run to mommy and daddy for $3 billion to bail them out. Long-term capital, same situation. And at the essence of their issues, I mean, they had structural issues in their portfolio. We can talk about the Russian default in 1998, which led to the debacle with long-term capital. You can talk about other things with respect to the hedge funds shorting GME. But the bottom line is greed. They overshorted. They shorted so much of the stock that it didn't take too much of mediocre mathematics to figure out how to conduct a short squeeze. And black swan events usually precede a liquidity crisis. And this whole GME thing is really a liquidity crunch. We could talk about how many shares were so shorted, the entire float, which is evidence of the greed. I would never have a guy trading for me at Drexel Burnham wanting to short 100% of the float. And it's just, I find it just amazing. It's greed, it's avarice, it's hubris, it's all of those things. And the GME was essentially a liquidity crunch to get the bottom line at the stock level with shorting the float, at the hedge fund level with being over levered and over devoted into one position, and at the broker dealer level. I mean, Robinhood wasn't prepared for this from a capital point of view. And on all three levels, we had a liquidity crunch, which resulted in the fiasco, and everybody was pointing the fingers at everybody else. And the hedge fund guys were saying, what the hell are retail guys coming up against us for? And the retail guys are saying, what the hell are you guys shorting the stock? It is worth more than $10. And you had, and then you had the broker dealer saying, do I have enough capital? Now, the bottom line of all of this is, and this is not the only solution, but it's one of the solutions, is that if they had same day settlement and clearing, the broker dealer would have known exactly what their risks were, and they wouldn't have had to shut down trading. So I'm sure they shut down trading for many more reasons than that. I don't have the facts. I have opinions, but I do know that if you peel away the facts, you'll find out that trading on a T+2 basis results in a dilemma. I mean, the dilemma is the day traders are generating profits on a real-time basis. They're using those profits. They're plowing them back in, whether they're making them on the derivative side using options or on the cash side using positions and stocks. And they're plowing those profits back into more positions. Meanwhile, those trades have not cleared and settled. The assumption is they will. clear and settle, and you had the backing of DTC and the government behind that. But in reality, if somebody on the street is going to default, go under, go into liquidity, all those trades get busted, and you have a domino effect. So it requires every broker dealer to take that settlement risk, and that's what we call it now, settlement risk, to a degree. And they couldn't, take it beyond what they did. Just as a backdrop from a commentary point of view, back in 1987, I was around when the crash happened. And those days it was T+5. So it took 5 days to clear and settle. And we had to shut down Wall Street for, I think, three days in order for the back office to catch up with the trading. So that is an anecdote. So you can imagine when you have T+2, and you had all this wild trading going on, and the hedge funds got into a frenzy too, insurance companies and other things. So no one knew their balance sheet. The hedge fund wasn't sure of his balance sheet. The retail guys weren't sure of their balance sheet. Were they making money or losing money? And what was their margin? How much were they paying for the margin? And would the margin last? And would they be allowed to continue buying calls and all that stuff? So clearing and settlement is something that I haven't heard on CNBC. If anybody has heard that discussed, I'd like to hear what they've heard. But that to me is one area that I'd like to contribute that needs some work in the system. They have to get it down to same day clearing and settlement. And blockchain technology, in my mind, is the only way to go. Of course, it'll take a couple of years to do all this, maybe a decade. But that is the vision that the people running Wall Street should have for the environment we're in. If you're going to have real-time trading, you got to have real-time settlements.